Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth right here in Singapore. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers. We just crossed the 1 million mark for number of reads and 58,000 likes. I've produced over 900 videos with more than 500,000 watch hours as of June 2025. I also focus on regional and global economic trends. If you're serious about taking your Singaporean investment journey to the next level, you'll want to hear this. Here's the thing that's keeping most Singaporean investors up at night. Should I buy Singapore REITs now or wait? Everyone's confused because REITs are trading at a 24% discount to fair value, but nobody knows if this is the bottom or if there's more pain ahead. Sound familiar? Well, I've got some surprising news for you. After digging deep into the data from over 40 Singapore REITs, I've discovered that this isn't really about interest rates anymore. There are 7 crucial insights that will completely change how you think about REITs in 2025. These insights could be the difference between missing out on generational wealth or positioning yourself for the recovery that's already starting. Today, we'll cover, first, why the Great Divide is happening in REITs right now. Second, the dividend yield trap that's fooling most investors. Third, the 3 pillars that separate winners from losers. Fourth, why interest rates aren't the main story anymore. Fifth, which sectors offer the best opportunities. Sixth, what institutional money flows are really telling us. And seventh, the valuation opportunity that might not last much longer. Let's start with point 1, the Great Divide. In the first half of 2025, Singapore REITs delivered a tale of 2 markets. The index only gained 0.6%. But here's what's interesting. Over half of the REITs actually posted positive returns. Think of it like this. Imagine you're at a buffet. Half the dishes are spoiled, but the other half are absolutely delicious. That's exactly what's happening with REITs right now. Fraser's Hospitality Trust delivered a massive 21.4% return. CapitaLand Integrated Commercial Trust gained 13.8%. These aren't lucky breaks. They show which REITs are adapting to the new reality. What does this mean for you? It means stock picking matters more than ever. You can't just buy the REIT ETF and hope for the best. You need to identify the winners. Now let's talk about point 2, the dividend yield trap. Singapore. REITs currently offer an average yield of 6.03%. Sounds great, right? But here's the trap. The highest yields often signal the biggest problems. Take Singapore REIT with its 9.5% yield, or United Hampshire US REIT at 9.23%. These look tempting, like a hawker stall offering chicken rice for $2 when everyone else charges $4. But ask yourself, why is it so cheap? Usually there's a reason. The sweet spot is REITs yielding 5 to 7% with strong fundamentals. These are like your favorite Z-Char stall. Good value, reliable quality, and they'll be around for years. Point 3 is crucial. The 3 pillars of REIT success. After analyzing all the top performers, I found 3 things they all share. First pillar, occupancy above 95%. Fraser's Centrepoint Trust reported occupancy above 99%. This isn't just good management. It shows tenants are sticky even in tough times. Think of it like HDB void decks. They're always occupied because people need them. Second pillar, positive rental reversions. FCT posted 9% rental reversion in H1 2025. This means when leases renew, rents go up, not down. It's like your landlord increasing your rent because your neighborhood became more popular. Third pillar, Singapore-focused exposure. Local REITs are outperforming overseas ones. Singapore is becoming a safe haven, like how people flock to shopping malls during heavy rain. For even more detailed charts, deeper dives into the data, and a full written breakdown of today's topic, make sure to check out our Substack. The link is right there in the description. Now for point 4, the interest rate reality check. Everyone thinks REITs will soar when rates fall. But here's the twist. Singapore's SORA already dropped from 3.02% to 2.08% this year, yet REITs didn't all rocket up. Why? Because most REIT debt is already fixed or hedged. It's like having a fixed rate HDB loan. Even if interest rates change, your payments stay the same. The REITs that will benefit most have shorter debt maturities and more floating rate exposure. Point 5, where the real opportunities lie. Let me break down the sectors for you. Data centers are the AI infrastructure play. These REITs benefit from long-term trends that don't care about interest rates. It's like investing in electricity companies when everyone started using air conditioning. Retail REITs are showing surprising resilience. Despite worries about consumer spending, they maintained 97% occupancy and achieved positive rent reversions. Singaporeans still need to shop, eat, and socialize. Industrial REITs face supply challenges with new space coming online. But quality players with strong sponsors can navigate this. It's like the best contractors getting projects even when there's competition. Point 6 reveals something most retail investors miss: the institutional money flow story. In H1 2025, institutions were net sellers with over 500 million in outflows. But retail investors were net buyers with 400 million in inflows. This is fascinating. Either institutions are rotating to other assets, or retail investors are spotting value that institutions haven't recognized yet. It's like seeing tourists avoid a local restaurant while locals queue up. Who do you trust? Finally, point 7, the valuation opportunity. Singapore REITs are trading at price-to-book ratios below 0.8 times. That's 20% below their long-term average. This presents a simple question. Are these fundamentally broken assets that deserve deep discounts? Or are they among the best value opportunities in global real estate? The data suggests it's the latter. Here's my personal take on all this. After covering Singapore REITs for years, I believe we're at a critical inflection point. The market is separating the wheat from the chaff, and that's actually healthy. My assessment? This is one of the most compelling opportunities I've seen for Singaporean investors in years. But, and this is crucial, you need to be selective. Don't buy the sector. Buy the best companies in the sector. For your CPF and SRS investments, focus on REITs with occupancy above 95%, positive rental reversions, Singapore-centric exposure, and gearing below 40%. These are the ones that will emerge stronger. My direct advice: start with small positions and quality names. Think of it like building your HDB. You don't buy everything at once, you build room by room. The same applies here. The institutional selling creates opportunity for patient retail investors. While the big players rotate out, you can accumulate quality assets at discounted prices. This is how wealth is built in Singapore, by being contrarian when you have conviction. So, we've broken down Singapore REITs, and I've given you my personal take on how it applies to your journey here in Singapore. If you found this video helpful and want to seriously level up your investing game, please give it a like, share it with your friends, and subscribe to the Investing Iguana channel so you don't miss our next insights. And for those who want to be truly ahead, our premium members gain exclusive early access to all our videos, often a full week before anyone else sees them. This means you get Iggy's detailed analyses and urgent insights on major market moves directly to your inbox, giving you a significant head start. It's just $1 a month, less than a cup of coffee. Think of it as your consistent daily dose of financial fuel for smarter decisions, delivered before the masses. Ready to join the inner circle and get that early edge? Just click the link in the description below to become a premium member today. Keep investing smart.